All right, everybody. Hope everyone is doing okay. So I've decided to slightly switch up today's lecture relative to what I said at the end of our lecture last Thursday. Because last Thursday, what I said was today we would start by wrapping up topic 2, and then we would start topic 3. I looked at our calendar, and I think we can do a better job than that. And in particular, today is going to be all topic 2. So we're going to do what I promised at the end of last lecture, but I'm going to throw in one extra example of a topic 2 type problem, because I did tell all of you that these techniques require practice, and I've really only done one tough problem so far. And so I think if I'm telling you that practice is necessary, it probably makes sense for me to do at least a second example in the classroom to like fortify that belief, right? So that's what we're going to do today. We're going to do a dirty example of static replication that is a little bit simpler. That is what I promised last Thursday. But then we will do one other example of a more elaborate problem, and we'll solve that. And that'll wrap up what we do for topic 2. Sound good? Here's another thing that I've decided to do. You know, like how we took a little bit of a breather at the end of topic 1, so that like you guys could either take a breather or use the time to think a little bit about the topic. That's what you guys are going to do this Thursday. So this Thursday will be no class. But if you don't need a breather, I would recommend try to solve during that class time an example of a static replication problem from, say, the practice final exam. And, you know, to use it as time to basically get more comfortable with this topic, right? So I'm just replacing me talking with you thinking, right? So that's how we're going to do that for this Thursday as well. And then next week, we will start topic 3. And topic 3, I'm going to ask you guys a question right now, which is, I want to find out collectively in the class whether you guys want me to put a basic topic 3 question. When I say basic, I mean high level. That just shows, do you roughly get it, right? Or do you want me to just not put anything on topic 3 at all in the final exam? I'm actually fine with both decisions, and so I want it to be a decision that you guys make. And so right now, I will ask you guys to answer yes, no in the in the little Zoom participant box thing. I am hiding the participant box from me, so I cannot see it, even though I actually don't like. I don't infer anything positive or negative with your answer. I know some students are worried about privacy, or I don't know what exactly it is, but like, so I want you to do the following. If you are cool with me asking a basic high level question about topic 3, where we will have fully covered what is necessary to answer that question by the end of next week, right? So by Thursday, November 19, if you are cool with that, hit yes. If you much prefer not having a topic 3 question at all, hit no. Anushka, if you could let me know the division, the counts on both sides.
It's 3-5. Sorry.
So 3 yes, 5 no. 5 no. So it's interesting because you guys have a very different view from the first section. First section was 5 yes and 1 no. So right now, in terms of the overall tally, well, what did you just say? 3 and 5?
Yeah.
So it's currently 8 and 6 aggregated across. So it looks like I'll probably not put the question on the exam unless we have another 5-1 tilt. Because I think the way I'll do it is I don't put it unless like 2/3 of students want me to put it. To me, that seems to be the right decision rule. And so right now it's much closer to 50-50. So right now I'm leaning not putting the question, but I will know better after after I'm done with the last section. But like, so for instance, if it ends up being 4-1, then all of a sudden we're going to be, if it ends up being 6-1, then I'm going to be 14-7, and that's 2/3 yes. Then I'll go with putting the question. But if it's like 2-0, and now I'm like 10-6, I'll still err with not putting the question. So I'm just fully revealing what my rule is going to be. And hopefully you guys think it's sensible. Sound good? Anyway, I can't see people's faces except for Guy, who is fidgeting around and celebrating. Don't know why he's still celebrating for, because there's no decisions made yet. But all right, that's where we'll stand with that, okay? Now let's actually go and wrap up our topic 2. Sound good? By the way, if folks could share their image, it makes it a lot easier for me to know whether I feel like folks are kind of cool with how the flow of stuff is going. All right. So, but what I'll do now is I'll move off of being a big image of me on the screen, and I'll start sharing my slides. Just like previous lectures, I'll be kind of toggling between my slides, doing stuff on the board, and doing stuff on the Black-Scholes template, right? Because that's basically what you end up doing when you're solving these problems, okay? First problem that we're going to solve is going to be exercise 5 in lecture note 2, part 2, which is slide 10 out of 32, right? This is going to be an example of a problem where we're using the same technique that we've used so far, the static replication. But as is going to become clear, and as I'm going to try to emphasize as I solve through the problem, this is going to be a much messier implementation of our technique. And what it means is we aren't going to trust that number as much as we did with the oil lease, or with like the jewelry line example. And I'll try to highlight why that's the case. Sound good? Right? So we'll do that first, and then we'll do another example of a complicated thing that I'll explain why that example is also uniquely interesting as well. Okay, so let me go ahead and share my slide. Can everyone see my slide? All right, perfect. So let's go ahead and read this. So by the way, this is an example. It's a super introductory VC example. So you guys, there's 3 goals with this problem. One is to show you an example of clean versus dirty. Another goal is to give you another example of static replication, right? And then a third goal is to, in the process of doing that, also teach you a little bit of VC for free, almost free, right? So, you know, if I can hit 3 things with one example, I think it's pretty good. Someone once told me, and I'm sure you've heard the same thing, that killing 2 birds with 1 stone is a good thing, right? I happen to believe that killing 3 birds with 1 stone is even better. Don't kill birds, let's be clear. That's not a good thing, but you know, 3 things with one swing is not bad. So that's what I kind of want to do here. All right, so let's go ahead and read this. And I'll tell you what about VC. My hope is that you learn from this. By the way, if any of you guys, I'm looking at the list. If any of you guys are in my VC course and you're like, what is he talking about? We haven't done this in VC. We're doing that in like a week. So I'm actually somehow covering it in ACF before I cover it in VC. Go figure. So let's take a look at this. So we've got a VC firm, La Jolla Ventures, LJV. It's a San Diego-based VC firm. And 2 years ago, it made an investment in a startup in the health IT space called Healthcare Connect, or HC for short. Currently, HC is estimated to be worth 60 million in face value. Sorry, not face value, firm value. That's the value of the whole company. Okay? It's not the value of just the equity. It's the value of everything that everyone owns. So all stakeholders, all investors, all founders, all employees, right? If you took all of those stakes, put it into like a bucket, that bucket's worth 60 million. Now, notice I use the word estimated because a startup is not traded. It's a private company. So we can't open up the Wall Street Journal and find out what it's worth every single day. And so there's some hard work that went into the background to guesstimate what the value of the whole company is. You don't just naturally get it from the market. By the way, this is the first thing that makes this example dirty, because HC as a whole, as a combined entity, is going to be the underlying in our example. It's going to be the underlying asset. And so the underlying asset in this example is not traded. Notice, what was the underlying asset in our oil lease example? Does someone remember?
It was oil.
It was oil. Is oil a traded asset?
Yes.
Yes. Oil is a traded asset. It's a little bit ironic that I am calling the oil lease example clean and I'm calling this dirty, okay? It's not that kind of clean versus dirty, let's be clear, and I don't want to go there, right? But that was what made the oil example clean from a financial modeling perspective, is that the underlying asset was actually traded. And all those call options and CNBCs on oil are also traded. That's clean. Here, everything that's going to be in our replicating portfolio is not traded. That makes it dirtier. So when we focus on that dimension of things, which valuation do we trust more? The oil lease valuation or the valuation that I'm eventually going to introduce here, just intuitively? Like, we trust the oil lease example more because every step we're doing, it's kind of closer to the data. And it doesn't involve guesstimates. Notice this is actually part of a broader theme that I also talked about in topic 1, which is I want you to know what you know and I want you to know what you don't know. Even if you're doing something that seems high tech, like using option pricing techniques to value flexibility, have the humility to know when you're doing it in a dirty way so that you shouldn't bet the house on the numbers you get. Does that make sense? I think I mentioned another thing, probably very early in the semester. It might have been in the first lecture. Because I always try to say this to students, that I want you guys to be famous, not infamous. You know, infamous is like the bad version of famous. It's famous for being a failure. Sorry, I shouldn't say it that way. For fucking up. Maybe that's even worse. The most natural place to become infamous is literally when you know something, but you don't know the boundaries of that thing. And you end up using that formula, thinking that you're using it in the right place, and you use it in the wrong place. And because you think you know everything, you don't have the humility. You take a ginormous bet on the basis of that, and then you get completely screwed. That's how you become infamous. It's when you're so overconfident because you don't understand what you don't know. Like, when I say I don't want you to be infamous, I mean I don't want you to do that. And that requires you to know the boundaries of stuff. And clean versus dirty is an example of that. But we also talked about examples of that in topic 1. And so that's a big picture thing I always want you guys to remember because it's important. I have a book somewhere in my shelf here. I won't be able to find it in real time. I know the title of the book. It's called Big Bets Gone Bad. And it's a story of really bad bets. The type of mistake that I just classified, it turns out the people running finances in Orange County in California, they became infamous, where they thought they knew what they were doing. They used formulas the wrong way. And then like Orange County went bankrupt. If you know anything about Orange County, I'm not sure how young you guys are, but there was once a show called The OC. I think it might have been on MTV or something like that. I don't know. If you YouTube The OC show, you'll see it's like a show of like really spoiled rich kids, which tells you something about Orange County. If a county with like that is filled with kids like that goes bankrupt, you know it's because someone really, really screwed up, right? Infamous. Yeah, infamous. You know, people wrote a book on those people, right? I don't want that to happen. And that's actually what justifies me being pretty anal sometimes about, let's be careful about what we know versus what we don't know. It's not me being a little nerd, right? It's actually relevant in the real world because it's very easy to think a formula can be used for everything, and it cannot. Things are not one size fits all. You want to understand when you put a lot of weight on it, when you don't, and stuff like that. Sound good? All right. Let me go back to reading the question. I think this was a valuable tangent that I just mentioned. Like, it's maybe more valuable than this problem. So let's keep on reading. So the company is worth 60 million as a whole, or at least that's what we guesstimate. However, this value is split between LJV and other stakeholders. As I said, I've mentioned them before, employees in the startup, the founders of the startup, and other investors in the startup. LJV's stake is structured as the following financial package. It is the security that LJV owns is something called convertible preferred stock with a liquidation preference of 20 million and an optional conversion to a 25% stake in the common equity of the firm. So I say this, you probably haven't heard that combination of terms before. You may have. If you're curious, it's really easy to read about it online. But if you haven't ever dug into VC securities, you may not know what some of these terms mean, and that's normal. I will explain it to you now, okay? Let me give a bit of background first. And this is some background on VC. When VCs make an investment, they pay money up front. They want to get something back. This is a characterization of every investment in the world, not just VC investments. But the thing that's unique about VC investments is that almost the entirety of the return that a VC hopes to get back happens on a magical day. They don't call it a magical day. They call it the exit date. Now, what is the exit date? The exit date is when one of two things, I'm oversimplifying here, by the way, but I'm giving you guys a good 80-20. The magical day is the day where the company they invested in either gets acquired by another company or when that company, loosely speaking, IPOs. Because that's, again, loosely speaking, when they get their money back, they basically never get anything back before that. Because you might think, well, wait a second, they could get dividends, right? No, they could in theory, but not going to happen in practice. It's tough for a startup to pay dividends when they're losing money, right? So like dividends don't get paid. So it's all about the magical day. By the way, the magical day sometimes never happens because a lot of startups fail, right? But it's all about the magical day. It's all about the exit date. Now let me explain in the shadow of this fact what convertible preferred stock or convertible preferred equity actually is. Convertible preferred equity is a security that gives the VC some options on the magical day. And in particular, it allows the VC to decide between two things. On the magical day, they get to decide, do I want my security to be debt or do I want my security to be equity? What happens if it's debt? That's all about liquidation preference. Liquidation preference means, so another day Another way to call the magical day or the exit date is to call it a liquidation event. Okay? So on the liquidation event, you get preference. That means you get your money first. That is debt. You get the first 20 million. Now, of course, if there isn't 20 million, you don't get 20 million. There's not that kind of magic, right? But if the company exits for 15, you get the whole 15. If the company exits for 40 and you choose to stick with the liquidation preference, you get your full 20. You guys understand what I'm saying now? So that's one option. But you have another option. You can say, I give up my liquidation preference. And instead, give me equity. And in this contract, when you say, give me my equity, you own 25% of the equity in the whole company. Make sense? You get to choose between those two things. If the company exits for $100 million, what do you prefer? What happens if you convert into equity? You get 25% of the 100 million, correct? That's 25 million. I prefer $25 million to getting $20 million. So I'm switching, right? The VC is able to do basic arithmetic. They will optimize. They will pick the option that gives them the most money depending on the exit value. Make sense to folks? Let me keep on reading a few other little things, but then we're going to be ready to solve this problem. Sound good? By the way, I define some features of convertible preferred shares in paragraph 2. I don't feel the need to rehash this now because I kind of said all that we need to know in words already. Okay? So I'm skipping paragraph 2 because I covered it and actually covered it better than the way it was written here, I see. Okay? For the purposes, like what's the goal in this exercise? The goal in this exercise is that we want to value LJV's stake. Okay, that's what we want to do. In order to do that, we need more information. What is some of the other information that we need? It's what I say in paragraph 3. For the purposes of the valuation below, let's assume that 1, the VC is committed to exiting the investment in 3 years. By the way, does anyone think that that's a realistic assumption? Yes or no? That's obviously not realistic. So this is a caricature. This is a bit of a cartoon. It's a cartoon that allows me to solve the problem using static replication. Okay? So that's another thing that makes this problem dirty. Right? So let's keep track of all the things that makes this dirty. Like, I believe the answer less because I know the world isn't that kind of cartoon. But it's still better for me to try doing this than to do nothing at all. Beggars cannot be choosers, right? 2, the volatility of HC's firm value is 50% per year. We will need this information. And by the way, it's tougher to get this here than it is to get it in the oil lease example, because the volatility of oil prices is easy to get. You look at the historical prices of oil, and you can calculate volatility off of that using at least a historical volatility estimate, correct? Because this company is not traded, it's really difficult to go and estimate its historical volatility. Would we agree with that statement? Right? Yet another thing that makes this dirtier. By the way, I'll give you guys a little bit of an aside, which is like, so I do valuations like this as side stuff, non-McGill stuff. And I'll tell you guys a little bit about how I get the volatility number in practice. I'm going to just describe it to you at a high level. Okay. What I've done is I've taken a big database of historical VC investments, and I've built, look, it's kind of a nerdy, complicated model, but I've built a model that tries to estimate how the volatility of an average VC investment, so the startup that a VC invests in, how that volatility changes over the life cycle of the startup. So what is the average volatility of a startup that is VC funded when it's really, really early in its life? Versus how does that volatility gradually fall over time as the startup matures but is still private? So I've built a model where I can actually take the input data and under a set of nerdy assumptions, spits out numbers on how that's changing over time. So that's how I get my numbers. I plug in, I say to myself, this startup, at what stage of the life cycle is it in? Oh, it's at this stage. My data says that the average startup at this stage has roughly this level of volatility. And that's what I use as at least a first pass plugin in my models. Then I make a judgment call. Do I think this is a little bit more volatile or a little bit less volatile than a typical startup at this stage? I do go through that question as well. But that's more this than it is numbers. But that's how I get those numbers. And again, I highlight this to actually tell you guys, like, I know everything I've done here, I've done the best I can. It's not perfect. I wish I had historical data on returns. I would believe that more than the hard work I put in. Because of that, I view my valuation, no matter how much hard work I put into it, as being dirtier than if this company had been publicly traded. But that's how these things are done. I mean, you still try to do the best you can. By the way, so usually the context that I usually do this is I get asked by a startup or a VC on the behalf of a startup to do this valuation. And when I deliver a valuation, I actually don't deliver one valuation. I deliver a collection of valuations under different narratives. So different narrative, like, are you an average volatility startup at your stage? Or are you a little bit higher or are you a little bit lower? And I let them decide. I'm like, on the basis of you, the startup, your decision on this question, you can tweak my number and my template will adjust automatically for you. That's how I deliver my product. Why? Because I'm like, I have no business deciding whether you're above or below average. I don't know your company well enough. So I leave it to them. I don't put the pressure on myself to do it. But I tell them, conditional on your belief, I've built the right model for you. Because that's what I'm good at doing, right? So anyway, it's kind of like, I know I'm doing something dirty, you know, like I want them to put the hands in their mud, not me, is kind of what I'm saying. You know, so like if it gets dirty in the wrong way, I want it to feel like their fault, not my fault. Right? That's, you know, that's important because it helps me protect my reputation. Right? So anyway, food for thought. I actually think this is reasonably good advice. So let's actually go ahead and solve this problem now. Sound good? Yes? All right. What is the value of LJV's stake? And then we'll talk about assumptions along the way. All right. So now we're going to move back to, I guess, me on the big screen or whatnot. And let's go ahead and start solving this problem on the board. Okay? What was this called? This was called a VC security. So VC example. Please let me know if I'm writing too small. You'll notice the first thing I always do is I draw these axes. Well, I don't know. Can you see the axes? Right? By the way, why don't I say this? If on the final exam, all you do is you put axes like this, I'll give you half a point. You guys have gotten yourselves half a point if you watch this fucking video, okay? So, okay, I'm gonna ask a little bit more. Okay, half a point if you put the axes. You get another half a point if you label the axes correctly. So, label the axes correctly. What is the y-axis? What are we valuing? We are valuing the VC security, correct? So what should be the y-axis? It is the payoff to the VC security. VC security payoff at t equals what point in time? Given the assumption. Yeah, someone, yeah, Guy giving me the 3. I don't know if this is a symbol for something else, but yeah. 3 years. All right, so that's right. And now what is the x-axis? Right, the x-axis is always the underline. So what is the underline? It is value of HC as a whole at t equals 3 years. So far, so good? So notice I'm being pretty specific because I said at 3 years, because all of this is happening in 3 years, per assumption 1 in the third paragraph of the problem statement, right? And I did say firm as a whole, right? So if you label that correctly, another half point. Like even if you do nothing else. I once taught a class where there was a bit of game theory in the class. And I'm not sure if you guys have ever studied game theory, but like the first thing you see in game theory is you see these little boxes where it's like person A can choose action 1 or 2, person B can choose action 1 or 2, and then you kind of do the Nash equilibrium off of the box. And someone just drew a square on the final exam, a square, and I gave them 1 point. Like, okay, well, at least you know you need to go towards a square. And I told them if you put a triangle, I would have given you half a point. So there we go. I want to give you guys partial credit. That's the general principle. On the final exam, I want to give you partial credit. Okay? I'm looking for excuses to do it. All right. So now let's keep on going through this. So what were the, okay, so I just need to remember the numbers. So I'm going to just have to pop up my screen. It's at 20 million. Okay, so 20 million. So I'm going to draw 2 payoff diagrams. Payoff diagram for option A, which is stick to liquidation preference, and payoff diagram for option B, which is switch to common equity. And you always pick the higher of the 2 options. Make sense? All right, so option A, stick with liquidation preference. If the company is worth more than $20 million, how much money do you make?
20 million.
20 million, so just plateaus. Option A, stick with liquidation preference. Again, you just associate liquidation preference with face value on debt. This isn't debt because if you don't get the 20 million, it's not like this goes to bankruptcy. So there's no bankruptcy involved with this security. What happens if you're between 0 and 20 million? If it's worth nothing, what do you get? Nothing. Just draw a straight line between those 2 points. It's a straight line with a slope of 1. That just means the first 20 million, you get it all. Does that make sense? Good. Now let's look at our next option. The next option is what?
Equity.
It's equity, and what is that? If this is y and this is x, what's the curve? Y equals
It was 0.25, yeah.
Yeah, exactly. Y equals 0.25x, because like you just own 25% of the company, and let's just assume there's no other debt in the company. There's no other liquidation preference in the company. So that is an embedded assumption in what I'm saying. So this is option B. And I'm going to call this convert to equity. That means give up your liquidation preference and convert that into just receiving common equity. Convert.
Jiro, when you're graphing it, the line should be, when the value is 20 million, it should just be a quarter of that 20, right? So when it hits that x-axis 20 million, it should just be like a quarter of the way from the x-axis.
So what do you mean by, oh, you mean right here?
Yeah.
Yeah, 1/4 of the way. That's correct.
Okay.
This is not a necessary thing to mathematically use, but the statement is correct.
Yeah, okay.
What is necessary mathematically is to find out when this crosses this, correct? So these two things are equal when what? This happens when 20 million
Equal to 20.
equals 0.25x, correct? In other words, when x is equal to 20 divided by 0.25, i.e. 80. Thank you for showing me your calculator, man. So 80 million. Are we on the same page here? Notice, like, when you do this systematically, this is not that complicated. So it's all about training the mind to think this way. And then it's easy. People love to say rocket science. That's bullshit. Like, this is not rocket science. If I tried to convince Elon Musk that this was rocket science, he would tweet some nasty shit about me, right? So we can also see here, although he's tweeted nastier, but now we can figure out what the actual payoff of the security is, right? Because who gets to decide? It's the VC. It's the VC's choice. So the VC always picks the highest thing. So the VC will do what? They will say, this is better. Better. Anyway, I could keep on saying this forever. It would annoy my vocal cords as well as your ears. So I will stop. But this is the best stuff to do. Do we agree? We are done with step one in the valuation problem. We understand our security. We understand it as a payoff diagram. We are good to go. What do we do next? Step two, replication. What do we do after that? Step three, valuation using the Black-Scholes model. Are we cool with this? Let's go ahead and do it. I want you guys to help me. Someone help me with replication, which is our step two. What do we do? What is the first ingredient? Do we need to use any riskless zero coupon bond here? Yes or no? No, right? Because it starts at 0. If it starts at 0, no is riskless zero coupon bond. If it starts positive, you go long the riskless zero coupon bond. If it actually starts negative, you go short the riskless zero coupon bond. But here it's just at 0. We don't need anything. So what's our first ingredient then?
You have to go long on the underlying.
Yeah, exactly. So long, how much? Long 1 unit, because the initial slope is 1. Long 1 unit of entire firm, that is HC, correct? Because notice, this was HC as a whole. It's the entire HC firm. That is correct, Eric. Now let me ask this question. Was this publicly traded or not?
No.
So why don't we also keep track of dirtiness? Because that's an important point of this, is to spot clean versus dirty, correct? So let's actually lay down everything that's dirty here. So dirtiness. First dirty thing, 3 years. That was a cartoon. 3-year exit. That's a cartoon, not realistic. 2, underlying, not traded. This thing isn't actually traded, so it's not like I can go buy it. It's like if someone sent me the recipe for a magic potion and, like, I don't know, there was ether. I don't know what ether is. I don't know where to buy it. You know, it's dirty. It's a little dirty. Dirty magic. So now what's next? Nonetheless. Ingredient 2. What is ingredient 2? Someone want to help me?
You would short 1 unit of a call option?
Yep, short 1 unit. Okay, so short 1 unit of call on entire firm with a strike price of what?
20 million.
20 million. And what maturity?
3 years.
3 years. Right? 20 million because the change in slope happens at 20. And it's short 1 unit because the slope goes from 1 down to 0. The slope falls by 1. 100% correct. What's the final thing we do? What was the slope here, by the way?
As 0.25.
0.25. So given that, what's the third and final ingredient?
You long a quarter of a unit of a call at strike of 80 million.
Yep. Of call on entire. I tend to be very specific, right? I say always exactly what the underlying asset is, and I also specify the maturity date, even though it starts to sound like a broken record. Entire with K equals 80 million, because the change in slope now is an increase in slope, which is why we go long, and it happens exactly as Eric said at 80 million. And then, we always repeat 3 years, 3 years. Everything that's a maturity or on either the bond, which isn't showing up here, or any of the options is always the same number. Because all of the action is happening on a specific point in time, which is exactly in 3 years. Folks, okay with this? We are done with step 2. Step 2 is complete. We have our recipe. So now we go to the last step, which is we want to find out how expensive is this recipe. Now, because things are not traded, let's add a few things here, right? Dirtiness, 2 prime. All derivatives on underlying not traded. Right? I say 2 and 2 prime because these are part of the same kind of dirtiness. Right? So we don't really know the price of this. We don't really know the price of this. We don't really know we don't know those prices. In other words, I can't go to open the Wall Street Journal or open a Bloomberg terminal and find the price. I'm not able to do it because those things aren't actually traded. But here's where the beauty of the Black-Scholes model emerges, is that technically speaking, to use the formula, the asset doesn't need to exactly exist. We just need to be able to plug in guesstimates for the numbers. What numbers do we need? We need a guesstimate for the value of the underlying. Well, that was given to us in the problem, 60 million. We need to have a guesstimate for the volatility of that underlying. It was given to us, 50% per year. So look, again, you go back to the same idea, like, is this perfect? Of course not. There's a bunch of reasons why this is imperfect. The Black-Scholes model is not a perfect description of the real world. Even if it was a perfect description of the real world, it theoretically applies to settings where the underlying is traded. So both of those things make this dirty. So a third dirtiness is Black-Scholes model is not perfect here. And then I would say 3 prime, we use guesstimates. Right? Our guesstimates are the $60 million number and the 50% number. So we know, like, it's not like we're building the prettiest structure of all time. But like, I prefer living in a hut than being homeless. So I will do what I can. Right? Right? So that's what we're doing, right? So again, it goes back to the theme, beggars cannot be choosers. Do the best you can. And if you're doing the best you can, it's easy to defend what you did, but just don't go all cowboy on decisions with the numbers. Right? So let's go ahead and, despite this dirtiness, go and use our Black-Scholes template to at least get a number. The number is informative to me. It is not the whole story. So when I'm dealing with a dirty situation, I try to find some other soap or something like that, which means I triangulate with this valuation and with a bunch of qualitative stuff I know, right? The other thing is, I mentioned it earlier, when I know I'm dealing with something dirty, when I have like described a pile of mud, I want someone else to have to touch the mud. Meaning I offload the difficult stuff that I am not the best person to do to the best person to do it. You know, on the one hand, you can view it as blame avoidance. If a bad decision gets made with the mud, it's not my fault. But on the other hand, it's also the right thing to do because I'm not the right person to play with the mud. I don't know enough. Look, if I was the right person to play with the mud, I would probably play with the mud because, you know, if I really, really knew the company better than anyone else in the world. But in what I've experienced in my own life, that's never happened a single time. And so it's made my life easier because the right person to play with the mud is not me. Right? These are things to think about, right? Because you start to think about, well, what do you do in this situation? You know, you might want, like, knowing what you know and knowing what you don't know allows you to think through, like, what do you want to be on the hook for? And what do you want to not be on the hook for? If you don't know what you don't know, you can't do that. So that's important. It's important for your long run reputation, right? And actually, it also helps, like, if you are the right person to play with the mud, you make sure everyone who's going to evaluate you afterwards, you want them to know that you are playing with mud, not with Legos, right? So that they don't think you created the mud. They realize that, like, you were dealt mud and did your best. So that if things aren't perfect, you properly do not get blamed for it. Like, if someone throws mud at you, it's not your fault that you get dirty, right? But if you can't explain why it was mud being thrown at you, you put yourself in a risk of being unfairly blamed, right? So again, this all feeds into this idea that it actually matters for you to be able to identify clean versus dirty. It actually matters for your career. Okay, let's go to the spreadsheet now. Let me share screen. Look, I'm actually going to be honest. My belief is that the stuff I'm saying to you guys that is not solving this problem is actually more important, actually, in my opinion, than what we're doing in solving this problem for like at a practical level for your careers. So yeah, so sorry if it distracts a little bit on solving this problem, but you know, it is valuable in my very honest and sincere opinion. Everyone can see my spreadsheet right now? Right, good. You guys want to be comfortable with this. By the way, let me reemphasize, I think I've already said it. You are allowed to use this template on the final exam, right? So get comfortable with it. I've actually already pre-filled the stuff needed for this problem, right? Because what we do is we pay attention to our replicating portfolio. There were 3 components, right? There was an underlying, there was a first call with a strike price of 20, and there was a second call with a strike price of 80, correct? So one column for each component, 60 million. So everything is in units of million here. 60 million, no dividend yield, volatility 50%, 5% riskless rate, 3 years to maturity. The strike price when I have my underlying column doesn't matter. So you can put any positive number, it's irrelevant. Okay? But the number is relevant for the call options because they have specific strike prices. 20, and 80. So these are the only parts of this template that we're using. So far, so good? Again, let me reemphasize. You can play with these numbers. Do not touch anything that is not yellow. You are doing yourself, I promise, a disservice if you do that. Like, don't ever touch it, because if you touch it now and you save it and you use it for the exam, you have tainted stuff. You got a different type of dirty. It's a dirty that doesn't help you out, right? Well, once we have this, we're ready to go, because we know our positions. It's 1 unit of the underlying minus 1 unit of the first call. If you don't remember what I'm saying here, it's literally what we wrote in step 2. And then plus 0.25 units of the second call. And so then what is the value? We just do shopping cart style. Value is what? Price times quantity for the first item, plus price times quantity for the second item, plus price times quantity for the third item. Shopping cart style, tally it up, $20, $20.7 million about. That is the value of the position. Folks okay with this? Again, the caveat is we made a lot of assumptions here. Do we truly believe this? No. Is this still useful? Yes. Could I have come up with a better number some other way, given the information provided in the problem? No. This is the best I can do. And that's it. Right? But I know I'll want to triangulate this with extra insights because I know this is dirty. Right? We listed the reasons that it's dirty, and we listed a few. Folks okay with this? So now let me go and share instead my slide again. Slide, where are you? Can everyone see my slides once more? So I now see that someone put in the group chat about 40 minutes ago, it's like Dunning-Kruger with extrapolation. We can talk about that later. I have no clue what that means. But I'm curious. So, Reda?
I'm here.
Yeah, we can talk about it later. Sound good?
Yeah, but it's exactly what you were talking about like people and like using like they're not that smart and they're using knowledge outside of the scope of like the formula.
Interesting.
And by the way, the value you said it was 20.7. That
Yep.
means that the convertible, for sure, because it has more flexibility, it's more expensive.
Mhm.
That's why it's more than $20 million. But let's say if it was just a bond of 20 million, would it have been just 20 million?
It would have been less than 20 million, right? For a couple of reasons. One, you're not getting the money right away. You're getting it in 3 years, correct?
Yes, correct.
And you're not always getting 20 million because there's a chance the company's worth less than 20 million, in which case you get less than that. So it would be like a bond with non-negligible credit risk.
Okay.
So the actual, so you're actually, Reda is asking a really good question. Because what Reda is trying to do is he's trying to get a handle of what the value of the conversion option to the VC is. Is that correct, Reda?
Yeah, exactly.
Yeah. That's a really good question, right? And by the way, we can actually answer that question rigorously, right? Let me actually stop sharing the screen. I will describe to you guys visually how we could do it. And then I won't actually do it. But if anyone wants to solve it and thinks they have an answer, send it to me. I will tell you whether your answer is correct. Okay? Because that's actually a really good question. What Reda is trying to do is he's trying to pin down the value of flexibility. What is the value of the VC's option? That's a good question. And it's a question we can answer. Let's go back to this big screen, or whatever this thing is called. What is this? So it actually will highlight, Rita, that the answer to your question is relatively straightforward when we're comfortable with these techniques. The security you just described, Rita, is this, correct?
Exactly.
Replicate this. How do you replicate that? Actually, you know what? We'll be able to answer it all super fast. How do we replicate this? You just get rid of the third ingredient, correct? Yes?
Yeah, exactly.
All right. Now, like literally, I mean, it's going to show you. This is so easy. This is actually easy. When you're comfortable with this, it's really easy. So let me go and share now my Excel. Can you guys see my Excel again?
Yes.
I only need to change one number and I'm going to have your answer. What number do I need to change? It's just one number that I need to change.
The third one.
Third one becomes what?
0.
Done. We have our answer. The value is 16.34 million. So what is the value of flexibility? The value of the option is actually quite valuable. It's like $4.35 million. Flexibility is valuable. Make sense?
Yeah, it does. Thank you so much.
No problem. Look, we have 20 minutes before the end of this lecture. The problem I wanted to do takes more than 20 minutes, and I actually solved it in full in my last lecture. So rather than actually try to finish that here, I'll just end things here, and you guys can watch the segment of the video for the second problem offline. Given that we have time off next lecture, I think it's fair for me to ask you to do that. And maybe what I'll do for the next 20 minutes is you guys can ask me any question you want. It can be about the case study. It can be about anything related to this material. We can expand on some of the stuff that you guys have asked about so far. I'm open for questions. Me trying to do in 20 minutes, the second example would not have much real-time value to you guys. Is that okay? By the way, you guys can also leave and, you know, go eat breakfast. I guess it's 12:30, so to go eat lunch. You know, you guys are allowed to do that too. I won't take it personally. Maybe I'll eat a little bit too. I got a banana. Any questions?
I just have a quick question, just about the course in general. So sorry if you've already answered this, but the presentations for case 1, is that going to be like first week of December-ish? Do you know when those are going to be?
I think you're assuming I have more of a plan than I have. I'm flexible.
Okay.
Like literally, like I am
Okay.
like, super flexible. If you wanted to do it, you know, next week, I'd find a way to make it happen. If you wanted to do it last week before the exam, make a way to have it happen. If you wanted to do it after you, I don't even remember what date our exact exam is, but if you wanted to do it just after that, we would make it happen. I'm like flexible. The only thing is like if you
Okay.
if you do the presentation, this is all off the record. If you do it, the presentation after the date that I need to file grades, I cannot incorporate it into the first version of the grade that I give for you. So I would like put a placeholder grade, assuming you just didn't do it. And then the moment you do it, I would regrade you to give you your score. By the way, that would actually, again, let's be clear, off the record, that would help me because it allows me to give people better grades and then use regrades in a good faith manner to bump up the curve. I am not a fan of a curve this semester. So like any trick in the book I will use. And I see that Eric has paused out. He's like, I like the answer. I feel very zen right now. I can sleep finally.
If possible, I selfishly want to just kind of continue probing on the potential case question that I had.
Sure.
Which was just about, so we would be getting data from 2000 to 2014 with 20 keywords being, I don't know, like whatever, like cost synergies and crisis and that kind of thing.
No, I would, yeah, but like you would have a set of words that are crisis words, and then you would have a set of words that are like the words that are more traditionally related to these transactions. So it's kind of like now in your thing, you've got two families of words.
Yeah.
Right? And so you'd want to think about both families.
And then those would be included, and you think just split it up 50-50 would be a fine representation, or weighted a little more on the crisis?
Sorry, can you repeat that?
Yeah, no, I was just saying, do you think it, to give it equal attention in terms of 50-50, or weighted?
Are you going to ask me to generate the words for the generate?
No, yeah, that's fair.
No. But that's an important question. Will you do it?
Oh, yeah. For you to run it, yes.
You're going to want me to do it.
Yeah.
Yeah. So you know what? I give you, do 20 words related to transactions, and I give you an extra 10 words for crisis, because I like what you're doing.
Okay,
so
cool.
30 words.
Yes.
I think it's fair.
That seems like a fine, so the interpretation of data once we get it back, I mean, the thesis would be... I don't
want to over micromanage what you guys are going to do. I want you guys to roam.
But it's fine to just like create a thesis and then validate or invalidate it based on...
By the way, if you have a thesis and then you find no evidence of it, don't worry. That's acceptable.
Okay.
I'd much rather you acknowledge that you couldn't really figure things out than for you to like play around with the data to give me bullshit.
Yeah. so the thesis would be more around the idea of like, so here are the words in the transactions that here are the words in the transactions that came up from 2000 to 2014. We should start looking at these for keywords to see if it's indicative of a crisis that can occur post-pandemic.
Yeah, that's fine.
Okay.
Look, part of it is like, there's actually one really important goal with these cases. Well, actually, this case, because I just decided to do one at the end of the day. I'm actually pretty happy with that decision, because I like case one more than I like case two anyway. Like a big part of this is for you to start having confidence in yourself and your own judgments.
Yeah.
And to realize I'm not looking for a specific answer. This is not a checklist where I'm like, if you did this, this, and this, and this, you get your points. Otherwise, what a disaster. No. I look at every submission on its own merits, and I enter in to evaluating it with an open mind. What I do want to see is more about mission than about detail, which is, are you taking advantage of this case to become more mindful of what you answer, why you answer it, what you're not able to answer, right? So that you show me you know what you know and you know what you don't know, and you have purpose in doing it. Like, I actually focus more on clues for that than on like nitty gritty.
Yeah.
Because those big picture things are things that you need to start building as part of your DNA if you want to maximize your potential in your career. I truly believe that.
Okay.
I lost you for a little bit.
Well,
can't hear
sorry,
you.
my internet went down there for a few minutes.
Yeah, it's okay.
So I guess that means, are we presenting just directly to you, and it won't be during like
directly to me, not in class?
Okay.
Like, we'll just figure out a Zoom time to do it.
Okay.
Honestly, it's the easiest it's ever been to arrange this.
Yeah, for sure.
Yeah. So, in the past when I've done this, it's like I have to like call like McGill building management to like find a classroom that's open. It's like an hour for each one booking in the sense that like the amount of like annoyance I have to do on the backside. And now this time it's just I send you a Zoom link.
All right, perfect.
It's never been easier for me or for you.
When we receive the data back from when you run it, will we be able to essentially just create a pivot table in which we can filter it by the date?
Send you the whole data set.
And it includes specific dates of when they were received and submitted.
You're literally going to have like 5,000 different filings, For each filing, you will know the name of the company, the industry of the company, the date of the filing, all the keyword matches, the size of the file. What I mean is like how long was the document. You will have links, web links to the document so you can click on it and actually see the filing. It will all be done automated. And then do take a second to think when you see that database, what if you had to do that by hand? How long would it take you?
Yeah, like an infinite amount of time.
No, you would never finish it. You would give up before you even made like 10% progress. You would give up. So it's the kind of thing that is impossible for a human, but possible for a computer. So, computers are good in some ways, but let's also not kid ourselves. Computers are not perfect. Keyword matching is not perfect. So keep in mind about how much you believe the numbers as well.
I wonder if we can use the file size as a proxy for
That look, trust me, there's a reason why there's a reason why the file size is given to you. It's because I took the time in my program to calculate that. If I took the time to put that in my program, it's because I think it's useful.
Yeah, I mean, legally you would think that during an M&A deal, the file size would go up because of all the legal stipulations within it, especially after a crisis.
Yeah, 100%. That's a good hypothesis. That's actually a good hypothesis. Check it out if you want. Literally, I want people to take this project and make it their own. Like, yeah, I would want every single project to be different and to reflect the unique interests that you guys have as groups. That's what it's about. That's why I also tell students, like, keep on working on it until you don't enjoy it anymore. It's like work on it while you're curious and pursue what your curiosity tells you to pursue. Yeah. Anyway, yeah, that's that.
I'll stop pestering you about it now. Thank you.
And don't over stress about it.
Awesome. Thanks, Jiro.
No problem. Have a good one.
Yeah, thanks very much.